Good morning, students. Today on this video, we're going to be looking at how to construct a cash flow statement. Now, if you remember, we did go through one in the tutorial, and we had used Madeline as the example to work. At the end of it, at the end of class, I asked you to attempt Red Flamingo as practice, and I promised to do a video for you showing the workings for it. So this is a video. So what I want you to do is make sure you have your worked solution with you so that you can work along with me as I go through the question. Remember, you can replay this over and over until you get a firm handle, a better understanding of this. Okay? So on screen, I have the question. And just to recap, remember I had said that you need 3 sets of documents to prepare a statement of a cash flow statement. You need 2 balance sheets. The 2 balance sheets, now called statement of financial position. Those 2 statement of financial positions are on screen, and you'll notice that we are doing the year 2011. So we're going to need a statement of financial position for 2011, which is this one, these 3 columns. And we also need the previous year's statement of financial position, which is 2010. And these are the data. So those are 2 of the 3 documents that you will need. The third document you will need is their statement of profit or loss. So in this question, note that it is not a full statement of profit or loss because you don't see any cost of sales, but you see the gross profit. You do not see other operating income. You do not see administrative expenses. You don't see selling and distribution expenses, etc. And you don't see finance charge. Please note, you do not see finance charge, sorry. So this is a condensed or a shortened version of the statement of profit and loss. Okay, so let us see now what else we have. You will also need some notes, and we have one note that speaks about some asset, namely the equipment being sold. The data says that it cost $35, but at the time it was sold, it had gone through some depreciation and was now worth $28. Now the fact that they sold it at a loss of $5,000 means that they sold it for less than it was worth. It was worth $28,000. If it was sold at a loss for $5,000, it meant that the cash that they got, the proceeds from the sale, was $23,000. So when we get into the calculations, we will revisit this note. Okay? So let me go back to the statement of financial position. Now for the statement of cash flows, most of the time we'll be doing some subtraction of information or data that is found right here on the face of the statements of financial position. So you'll see that the cash flow statement, in essence, arriving at the figures, you can get some quick answers for those figures where you just simply subtract the figures here But there are some of the calculations that will require T accounts. And just to name a few, we have the assets. We'll have to do T accounts for those. We'll have to do T accounts for dividends. We'll have to do T accounts for taxes. And we'll have to do T accounts that involves using this 10% to arrive at an interest figure. And in this case, for 2011, the interest proper for the question is 10% of $37,000, which is $3,700. And so we will have to do some T accounts for that. Now, the only point I want to make before I switch over into the Excel sheet to do the calculation is to know that the starting point for the statement, the cash flow statement, is called profit before interest and tax. Profit before interest and tax. Now, if you look in this condensed statement of profit or loss, there is nothing like that. We see sales, we see gross profit, we see profit before tax. Now, if you remember from your company accounts, profit before interest and tax was a line in itself on that document, but you found it somewhere before the line that is saying profit before tax. And by the way, do you realize that this 325 is not found by subtracting 550 from 950? So just because you see this underlined number of 550,000, it doesn't mean that you're going to subtract these two. It's just that they've pulled the figures out, and I'm not sure why they have underlined this one. They shouldn't have, because there's no relationship between these two figures. But back to my point, I strayed. This 325,000, we are going to have to use it to arrive at the starting figure for the cash flow statement. And what we're going to do, we're going to simply add back the interest, the finance charge that is associated with the 10% debenture. So, with that information, let us now go over to the cash flow statement that I'm going to work on in Microsoft Excel. So now we're on the Excel sheet, and I have gone ahead and copied the template that I used in class on Wednesday and just deleted some stuff that was necessary in order to have this ready. So let me just do some more cleanup here. Great, so now that I have cleaned up the statement a bit, we can go into the discussion. Now, when I started working the solution at this week's class, I color-coded the sections for the cash flow statement so you could have a better visual of what you're working with. Now, I mentioned to you that the cash flow statement has 4 distinct sections. The first section, which I have here in this orangey yellow color, will cover cash flows from operating activities. So Red Flamingo went into business to make a profit. For them to do so, they had to be buying inventory and selling inventory, whether they want to call it inventory or stock, but they were buying and selling something. Now, this buying and selling activity represents the operating activities And these are the things that are repeated every day. Every day they buy and sell. So at the end of the year, we use the cash flow statement to find out what was the cash generated or used up while Red Flamingo is doing its buying and selling. So these lines that we have here take into consideration these buying and selling. So it's going to impact inventory. It's going to be impacted by the debtors, by creditors, the tax that is paid, any interest. Then we move to the second section, the investing activities. And this section deals with any changes in your non-current assets and any changes in your long-term investments. So just look at a few of the lines. There are only 4 of them. You're going to have in this section a line called proceeds from the sale of non-current assets. This proceeds here represents the money that was collected when the asset was sold. So when you're selling assets, any money that is received from that sale goes in this section. Also in this section, if any non-current assets are purchased, again, the money that is spent for that will also fall in this section. Now let me just interject here and say that any cash that comes into the business will be shown as a positive figure, and any cash that leaves the business, as in the case where they are buying new assets, will be shown as a negative or bracketed figure. Then we go to the purchase of long-term investments. What are long-term investments? A company, if it has extra cash that it doesn't need for the immediate, they can go and buy things like shares in other persons' businesses. These purchase of shares will then be held by them for a very long time, probably 2, 3, 5, even 10 years or more. And so these long-term investments, that initial money spent to buy them, will show up as a negative figure in this line. Now the other part is redeeming long-term investments. Now what do you mean by the word redeem? Whether the investment is long or short term, the company may decide, listen, we need this cash, we need cash from this investment. So they're going to go back to the organization that they purchased the investment from, and they want it to be sold by the organization, and they get that cash and put it back into the business. So when a company redeems shares that it bought, for example, from another company, it will sell those shares back to somebody else, get that cash, and put the cash back in the business. And this redemption of long-term investments will be shown as a positive figure. So all those transactions that involve non-current assets and long-term investments will show up in this section, the second section of the cash flow statement. Then we come to the third section, and this section deals with shares, share premium, and the debentures. Now, if a company issues shares to the public, it means that they're going to get cash in exchange for that. So this issues of shares will represent cash coming in, and so this line will have a positive number. I am now going to insert a new line which will apply if a company buys back, if this company redeems its shares And in this case here, issuing of 10% debentures, when a company issues debentures, what it simply means is that they're giving private individuals a piece of paper. It's called a debenture instrument, a piece of paper to say, listen, you now are going to give us money and we will turn around and pay you interest. All that information will be on the debenture document. So when a company issues debentures, what they're basically doing is getting cash into the business to use. Remember, a debenture is a loan. So rather than approaching a bank, companies which are financially strong will approach individuals and ask them for a loan. So the money that they get from these individuals will be the debentures. And so when they issue debentures, they will be bringing cash in. Now, when they redeem debentures, it means that they're paying back these loans, and this will be cash outflows because they're spending money to clear the loan. And the last line item in this section is the payout of dividends. So the dividends being paid out will have to be an outflow, and the figure from that will have to be bracketed to show that it is an outflow. And this dividend has to be determined by T accounts. So this is one of the lines where to arrive at this figure, you have to create a T account called dividends. Now, when we complete all three sections, we will list the line items in the inner column and give the subtotal in the outer column. So at the end of the creation of these first three sections, we will take the figures in the outer column, add them up, and we will end up with a line called net movement in cash and cash equivalents. Now, I did not explain the term cash equivalents, but over here, I had noted it last time we met, and it says cash and the cash equivalents will include cash that is found in the office, money that is kept in the company's bank account, and short-term investments. Let me put that in, that word is missing. Short-term investments. And an investment is identified as short-term if the duration of the investment is 90 days or less. Let me put that in. 90 days or less. So usually whenever a company has short-term investments, it provides them with a stash of emergency cash that they may need for whatever reason, probably to help to shore up the payroll because the money they have to cover the payroll is short, so they can quickly cash that investment if necessary. Or if they want to purchase an asset and they need to provide additional funds outside of, say, a loan that they were using to buy that asset, they can encash the short-term investment. So it's a quick way to have money, or to get money, by accessing these short-term investments. And so that we refer to as cash equivalents. And so cash and cash equivalents will include cash, money in the bank, and short-term investments. So the fourth section represents a reconciliation of this cash and cash equivalents. So whatever figure we find here must be the same figure we're going to find here. If you remember from class, we started this whole worksheet by computing the opening cash and cash equivalents, computing the closing cash and cash equivalents, and the finding out that the difference between these two figures would be caused by the net movement in cash and cash equivalents. And I said to you that one way to make sure that your cash flow statement is correct is to check these two figures. These two figures must be saying the same thing. Okay? So I am going to switch over to the question so that we can look at the workings for the bottom part of the cash flow statement. So we're going to have to go to the statement of financial position to get the data to complete this section, which is what I am going to start with. Okay? So here we are back on the question. Now what we're trying to see is what's the data for the cash and cash equivalents. Now, as I said earlier, the cash and cash equivalents will be made up of short-term investments, the bank, and cash. Now, one of the things that you have to appreciate in terms of the concept of creating these cash flow statements is to recognize that if we are doing financials or cash flow statements for 2011, this will constitute the closing position for that financial year, December 31st, 2011. But the second statement of financial positions data for 2010 serves this important purpose. These figures represent the position of the business on December 31st, 2010. But the next day is January 1st, 2011. That day is the first day of the financial year that we are focusing on, which is 2011. So that is the reason why, when doing cash flow statements, we need the previous year's statement of financial position, because those figures are going to be the same figures applicable the next day, the next calendar day, which is the start of the new financial year that we're working on. So back to this. These figures here, the 15,000, the 10,000, and the 12,000, even though they belong to the statement of financial position at December 31st, 2010, they are also the same figures for January 1st, 2011, which is the starting date for the financial year 2011. So these three figures will constitute the opening cash and cash equivalents. So we go now into this data here to get the closing cash and cash equivalents. And what are they? The 25,000, the 6,000. And class, if you see bank for $0, check your current liabilities category, because there may be an overdraft. So when I scroll down, there it is. It's a bank overdraft. So in this question, the bank figure is not under current assets for the 2011 year end. Instead, we have a bank figure for bank overdraft of 5,000. Now the thing to note, when we're arriving at the opening cash and cash equivalents, we will start with the 15,000. We will plus 10,000 plus 12,000. But when we go to the closing cash and cash equivalent, we will have 25,000 less or subtracting 5, then adding back 6. So essentially, the cash flow statement is simply explaining how the company moved from this position with the cash and cash equivalents to this position at year end with the cash and cash equivalents. So let us now go back over to the Excel sheet and put in our data. So now we're back on the Excel sheet and I'm going to put the figures in. So remember now you would have done your working, so you're going to be checking what I have. So we start first with the short-term investments of 15,000. Then we're going to add the bank figure of 10,000. And finally, we add the cash figure of 12,000. So it means that the opening cash and cash equivalents is $37,000. Now let us put in the figures for the closing cash and cash equivalents. We start with the short-term investment of 25,000. We subtract the bank overdraft figure of 5,000, and then we now add in the cash figure of 6,000. So it seems as if the cash and cash equivalents position worsened over the financial year for Red Flamingo. Remember, the name of the company is Red Flamingo, because they started off with $37,000 of cash and the cash equivalents. But then they end up with a lesser figure of 26,000 for cash and cash equivalents. So it means that during the year, the net movement in cash and cash equivalents was a negative 11,000. So overall, they paid out more money than they collected. So it means that this row here, which will represent the sum of the three sections we discussed, this final row is going to be the same figure. That's what we expect, negative 11,000. So now we're going to go into the calculation for each section to see how well the business did with these three activities: operating, investing, and financing. Now what I'm going to be doing is putting on the easy figures first. What do I mean by the easy figures? The ones where you just simply had to subtract the figures on the statement of financial position. So if you get a question like this in the exam, one approach could be to just quickly put on the document all the figures that are easily calculated. So the first figure, I'm starting from the top of the statement of financial position, and the first figure that I see is a goodwill. So you'll notice that there's a line in the operating activities where we're going to slot in the goodwill. So the goodwill in the previous year was $110,000, but the goodwill in the current year was $35,000. So some amount was written off or amortized, and so when I subtract the 110,000 from the 35,000, I get 75,000. Now this is one of the adjustments where we have to add back this amount amortized, add it back to the profit before interest and tax. Notice I have some little signs to the left. So for these three, we have additions. For this one, we have subtraction. Now let me explain why we add back the goodwill. Because it was initially deducted in the statement of profit or loss to arrive at the profit before interest and tax. So if we're going to move the profit figure to as close to cash as possible, we have to deal with those non-cash transactions. And here are my two non-cash transactions: depreciation and goodwill. Okay. Now when I scroll down, the next item I see that I can do calculations on from the face of the statement of profit of financial position is stock, also known as inventory. Now here's the thing to note. The inventory can either decrease or increase when you look at the movements year by year. In 2010, the previous year, the stock figure was $32,000. But in the current year, the stock figure fell to $25,000. So when the stock figure falls, we say that it falls because the company made a sale. So a sale of stock would be represented by a fall in the values year by year. So if this happens, we can represent this as cash coming in, because once a stock is sold, it means that cash should eventually come in. So I'm going to represent this calculation as a positive figure to show cash coming in. So it'd be 32,000, which was the figure for the previous year, minus 25,000. So the change in inventory year by year was $7,000. The next item that I see that we can do a quick subtraction on is our debtors. So let's line that up, debtors. When I look at the debtors, it went from 12,000 in the previous year to 16,000 in the current year. So from the fact that debtors has gone up, it means that your cash, Red Flamingo's cash, is being tied up. That money is sitting on the road. And so the change, which is the difference between these two figures, will be shown as a negative figure. So let me do that. So it's 12,000 in the previous year minus 16,000 in the current year. So we have a negative figure of 4,000, representing a situation where the debtors have gone up. The next figures in our working capital movement section is your creditors. And when I look on the document, I see where the company started with $17,000 in the previous year. So the year started, 2011 started with $17,000 and it went up to 22,000. So when your creditors increases, it simply means that you're not paying them. It simply means that you're using the creditors as a means of withholding their money and using that cash, instead of paying them, using it to do other things. So whenever your creditors increases, it means that you have a source of funds, and we're going to refer to that with a positive figure. And so I'm going to start with the bigger of the two, 22,000 for the current year, minus 17,000. So I wanted the figure to be positive, so I started with the 22,000, and I subtracted the smaller figure, the 17,000. Now, when we were doing Madeline question earlier in the week, we had another working capital item, accounts payable, but it is not present for this week, so I am going to delete that line. Good. So going down the list again, we're looking for those easy calculations. The next one will be share capital and share premium, which will be in the financing activities. Now, when I look at the figure, I see where I have share capital and share premium. And so we have to work the two together, if you remember. And if you look at my description, it says issues of shares and share premium. And so let me work the figures down here so you can see what I mean. In 2010, the share capital figure was 220,000. Let me move this up a bit. In 2010, the share capital figure was 220,000 and the share premium figure was 15,000. So remember, we have to work the two together, and so combined we have combined we have 235,000. So this figure is a year. In 2011, we have to again add the figures. So the share capital in 2011 was 210,000 and the share premium was 50. So combined, the figure fell. So what this means is that some of the shares were bought back or redeemed. So remember now, when they issue shares and share premium, we have a positive figure, and we know that shares were issued if the share capital and the share premium went up year by year. But in our question, the share capital went down. So what it means is that they went and bought back the shares that they initially issued. So by buying back these shares, which is what redemption is, they are using up money. So we're going to represent this by a negative. So I'm going to start with the smaller figure, 225,000. Here we have it down here. And subtract from that 235,000. So it means that they bought back $10,000 worth of shares that they issued initially. And this is represented by a cash outflow, let's use the terms, by a cash outflow of $10,000. Now the next item that we can quickly calculate is the debentures. When I look at the figure, the debenture at the start of 2011, which is January 1, 2011, was $202,000. But by the time December came around, the figure for the debenture fell to $37,000. And so it means that they have paid off or they have redeemed the debenture. So again, this represents an outflow of funds, because if you're paying off a loan, you're going to be using your company money to do so. So again, let me start off with the smaller figure, which is a 37,000, and subtract 202 from that. So they use $165,000 to pay off the debentures. So they bought shares. So in the financing activities for the year, they bought back some shares and used up money to do that. And they paid off the debentures. And again, they used some money to pay that. So the only thing that we have left is the dividends paid to work out. Now, basically, that is it. So we have done all the simpler calculations. So just to recap, this would be the goodwill, the movement in the working capital, which is debtors, creditors, and inventory, the movements in shares and share premium, and the movements in debentures. So since we're now at the other section, we're going to look at the T accounts. We might as well stay with dividends paid and work that figure out so we can wrap up the financing activities. All right, so let me shift my screen a bit. And here we have our dividends account. Let me just highlight it for you. Let me use a different color so we won't mix up. All right, let's use about the same blue. So for the dividends tier code, our objective is to work out what the dividends paid was. So here's how we're going to arrive at that figure. We start off first with the opening balance for dividends payable. So I'm going to just make a note that looking at dividends payable. So when I look on the statement of financial position, the opening balance for dividends was payable was $10,000. And on the same document, I see the closing balance was $25,000. Now, the third figure that I will need, dividends, the third figure that I will need comes from the statement of changes in equity, SCIE. So you'll notice that the prior year statement of financial position, PYSFP, that is where we went to look to find the 10,000. Then the closing balance of 25,000, we looked in the current year's statement of financial position, CYSFP, and we got the figure there. So now we need to look at one of two places. If the question gave you the statement of changes in equity, you would look there. But what they have done for this question is to put it as an extension of the statement of profit or loss. So when I go there, in fact, let us jump. So when I scroll down to the statement of profit or loss, there I see dividends. So what this means is that the dividends paid and proposed that we would normally see in the statement of changes in equity is merged with this condensed statement of profit or loss. So this figure represents the expected payout for dividends for 2011. And that is a figure that we want to complete the tier count so we can work out the dividends paid. Now please remember, this dividend of 34,000 need not be the dividends paid for the year. So don't get the figures mixed up. Okay, let's go back to the cash flow. So now we're back at the cash flow. So we need to put as the dividends paid and proposed $34,000. That was the figure we had. So it means then that we have to find the dividend paid as a balancing figure. If you remember from your control accounts. So the total on the debit side is 44,000. So the total on the credit side must also be 44,000. So the missing figure here that would make that side 44,000 is 19,000. So let us look at it. They started the year, that's Red Flamingo, owing $10,000 to shareholders. During the financial year, they said they would give them an additional 34,000, which means that in all, they should have paid out $44,000. But at the end of the year, apparently they didn't, because they still owed the shareholders 25,000. So it means that all they paid out during the year was $19,000. And that is the figure we want, the dividends paid, to complete the financing activity section. So let's put in our 19,000. And because remember it's a payout, so it means that it has to be a bracket. So they spent a good amount of money in financing activities in 2011, from buying back shares, from paying off the loan, and from paying out dividends, which gave you a total of 194,000. Okay, now let's see if we can work on the cash flows from investing activities. Now let me jump over here to say that sales proceeds is the cash collected from the sale of the assets, and I have this little reminder here to let you know that you need to look in the notes for this section. So in the notes, let's jump back to it. Sort of be jumping back and forth, but it's good when you can see the figures that I'm talking about. So here is the note. We only have one footnote. So what am I looking for? I'm looking for the sales proceeds. So you can take a picture of this if you have not done so, the question, so we can have it for reference. So the asset that was sold was equipment, and it was sold for an amount which you're going to find out in a minute. But at the time of sale, it was valued at 28,000. So if they sold it at a loss, it means that they sold it for 5,000 less than it was worth. So it means that the sales proceeds here is 23,000. So let's go back to the cash flow statement and record our $23,000. So let's put in our, and now because it's money coming in, it's a positive figure. Now I think I did some workings. Here we are. Let's look at these workings. The equipment that was sold had cost 35,000. Its net book value was 28,000. So it means therefore that it had experienced depreciation of $7,000. So $7,000 of depreciation was experienced by the asset before it was sold, which brought it down to 28,000. So this is what it was worth on the day it was sold. This is what it was worth on the day it was sold. But if they sold it for $23,000, it means that the loss on disposal, it's not a gain, it's a loss. On disposal is $5,000. Okay, so it was sold for 23, it was worth 28, so there was a loss. They sold it for less than what it was worth. All right. So the next task is to, let me put some zeros for these two because there are no long-term investments. So the only figure we have to work out is the purchase of non-current assets. Now I put two exclamation marks here to remind you that you must always check. You must always check for this. It is never going to be given to you in the question. You have to go and check it. So I say here that you have to prepare T accounts for the non-current assets to determine if any asset was purchased. So you must always do this check. So let us go now to find that out. So this is where I had the T account last time. So I'm just going to change this to equipment, because when I look in the statement of financial position, there is no tangible assets like we had in class. They had two assets clearly stated. One was building and one was equipment. Now, for the equipment, we have to look to the previous year statement of financial position to get the opening balance for the equipment. And that figure was $210,000. For the closing balance, figure, oh, by the way, the opening balance for an asset is always a debit. And if the opening balance is a debit, the closing balance is a credit. Where do we get the closing balance from? The current year's statement of financial position. The closing balance for cost is $290,000. Now you were told in the question, and we have it here, that the equipment that was sold had cost $35,000. Now remember, at the start of the year, the $35,000 was a part of the opening balance. So if you're going to get rid of that $35,000 asset, you have to do a credit to do that. Good. So our credit side is now complete. We have a total of $325,000. So the debit side must also be $325,000. It means that when we subtract the 210 from the 325, we will know what asset was purchased, what asset value. $115,000 of assets was purchased, and this is equipment asset. Figure is $115,000. Now, when you're purchasing a non-current asset, you're using up money to do so. So it's going to be a cash outflow of $115,000. But what did I tell you? You have to check all your asset accounts, because there's a building account, and I'm going to also check if any asset building was purchased. So I'm going to copy and paste my T account, and I'm going to refer to it as building. And let's run this again. The opening balance for the building was $250,000. Again, coming from the prior year statement of financial position. There's nothing on the building that was disposed of, so that was $0. The closing balance was $275,000. So when I look, if the total on the credit side was $275,000, the total on the debit side is $275,000. So they did purchase some assets for building. So they probably put an extension on the building, probably built a room or raised the roof or something. So there was an asset purchased of $25,000. So not only did they buy equipment, they extended the building and spent $25,000 on it. So let's put that figure in. So combined, they spent $140,000 on non-current assets. So we're finished with this section now, because remember, there are no long-term investments in this question. So for cash flow from investing activities, they used $117,000. And down here they used, not generated, used. So let me change this to net cash used for financing activities. Okay, so they're spending a lot of money that year. That is probably why they ended up with this negative figure here. Now, just as how we did T accounts to work out the dividends paid, we're going to do the same thing to find the taxation paid and the interest paid. So we're now in the last set of calculations, which is the cash flow from operating activities. So I'm jumping all over the place, building up from the least difficult to the more challenging. And so this is the next set of T accounts that we encounter, the ones to work out the taxation paid and the interest paid. So let's move over to the T accounts, and I'm going to put them in the same color as next door. Here we are. Now, where do we get the opening balance for the taxation and the interest? These are found in the current liability section. So we have to go back to the previous year statement of financial position to pick up these figures. And we find them under the current liabilities. So when I go to the current liability section, I see where the taxation paid at the start of the year was, the taxation payable. Let me change this to taxation payable, so it'll be easier for you to reference it. So the taxation payable was $14,000. And at the end of the year, when we go to the current year's statement of financial position, we found that they still owed $19,000. Now, where would the taxation expense come from? It would come from the statement of profit or loss. So when I jump to the statement of profit or loss, the taxation was $145,000. So the credit side of this account comes to 159. So let's put it at 159. So the taxation paid is the difference. That figure that when included would make the debit side also come to 159,000. So apparently, Red Flamingo paid $140,000. Let's put that in. It's a payment, so it's going to be a bracketed figure. Let's go now to the interest. There was no interest payable at the start of the year. There was no interest payable at the end of the year. But we have to find out what is the expense, and we noticed that it was the debenture was a 10% debenture. That is where we're going to go to work out the expense. Come on, man, let's solve this out. 10% debenture. So the debenture was $37,000. So the full interest for the year is 10% of $37,000 which is $3,700. So that is what we're going to pick up in the T account as a true expense. Ouch, my computer is not cooperating at all. Good. So the interest expense is $3,700. So it means that the interest paid was $3,700. So when you look at it now, they started the year not owing any interest. During the year, this is what they should have paid. But if at the end of the year they owe no money on interest, it means that they must have paid the full $3,700. So let's put it in as a cash outflow. Okay, so what do we have left to do? We only have to work out the profit before interest and tax. And we have to work out the loss on disposal, which we already know. That loss was $5,000. If you remember down here, here's a loss, $5,000. So there's no gain on disposal. So I'm going to just leave that as 0. A gain on disposal would occur if they sold any assets for more than what they are worth on the day. Okay. Now the next T account, should I say the final T account, is depreciation. And as I say in my note, you have to prepare a T account for the account provision for depreciation. So I have it preset. So let's go there. And here we have it. Again, provision for depreciation is a provision. It behaves like a liability. Its opening position is always a credit. So we're going to look to the prior year statement of financial position for the figure. Now what I'm going to suggest that we do is to group, they only gave one combined figure for depreciation. Okay, so at the start of the financial year 2011, which is the same figure as the closing 2010, the provision for depreciation figure was $15,000. At the end of the year, let me just make a change here. At the end of the year, we're using the current year statement of financial position, and that figure for depreciation was $35,000. Now, the last figure we need to include before we find out what the depreciation expense is because that is our missing figure right here. We need to find out what was the depreciation on the assets sold. Now, if you recall, we had worked that out to be $7,000. But let's look at the logic of placing it here. When the year started, that $7,000 was sitting in this figure because the assets depreciation was present at the start of the year. So if during the year the asset was sold, it means that you have to remove the $7,000 that was here on the credit side. And how do you remove a credit figure? By doing a debit. So we include the $7,000 as a debit, which means that the total on our credits or debit side is $42,000, which means that the total on our credit side must also be $42,000. So the depreciation is a missing figure. It is that figure when you include it, makes a total 42,000 on the credit side. So our depreciation expense is $27,000. Let's put it in. So now we can wrap up this section of the cash flow by looking at the profit by working out the profit before interest and tax. So at the last class, I was showing you this little calculation here because the question gives you PBT, but we are interested in PBIT. Now I put this little part here to show you how when we were doing the statement of profit or loss, we had the profit before interest and tax. Then we subtracted the finance charge, which is where you put the interest. And when we did that subtraction, it gave us the profit before tax. Now in the question, the profit before tax was $325,000. So to get to PBIT, what we have to do is to add the interest, the debenture interest of $3,700 to arrive back at the PBIT. So we're going to start with the $325,000, which was a profit before tax, and add the interest. We are reversing. We're going from here to here. So if we're reversing, we're going to have to change the sign and add. We're going to put 3,700. Good. So what does this tell me? It tells me that Red Flamingo during the year ended 31st December for the year ended December 31st, 2011, generated $300,000 for trading, for operations. However, they used up $117,000 of that to invest in new assets, with support from the sale of some old assets. During the year also, they used up some of that $300,000 to clear their debenture debt, to pay dividends, and to buy back some shares from the public. That came in total to $194,000. Now we are expecting these three figures, this one, and this one, to come to 11,000. So let us just delete this and check. So I'm going to sum. Now I get back the 11,000. So because adding these three gives me 11,000 negative, and down here I have 11,000 negative, it means that my T account, my cash flow statement, was correctly done. All right, so this marks the end of the video. So I hope going through has helped you to clarify any mistakes that you may have made when you were attempting it on your own for homework, as I suggested. All right, so feel free to send me an email if you have any issues, and I will see you at our final class next week, Wednesday. Have a good day.